Hey, welcome back to Channel S Quick Invest. Everyone is waiting for AI burst. Is the AI boom a bubble? It's the trillion-dollar question that defines our market today. We see the insane valuations of companies like Nvidia, Microsoft, and Google. But to understand the future, we have to look to the past. We're going to compare today's AI frenzy to the most catastrophic bubbles in history, the dot-com crash and Japan's lost decade. We'll show why the AI run-up is different, more dangerous in some ways, but ultimately, why we predict a correction of around 30%, not a complete collapse. Bubble 1. Japan's lost decade. Let's start with the worst, the 1980s Japan asset price bubble. This was not a tech bubble. It was a systemic crisis driven by real estate and massive bank lending. It was so extreme that the ground beneath the Imperial Palace in Tokyo was theoretically valued at more than all the real estate in California. When it burst in the early 90s, the damage wasn't limited to the stock market, it triggered decades of economic stagnation. It was a crisis of leverage and systemic banking failure. Key takeaway: the severity came from the entire economy being leveraged against inflated assets. This is the gold standard for catastrophe. Bubble 2, the dot-com crash, Cisco. Next is the one everyone remembers, the 2000 dot-com bubble. This was a crisis of profitability. Companies were valued solely on future hope, not cash flow. Most were burning cash. Cisco, a profitable company at the center of the infrastructure build-out, reached a mind-boggling price-to-earnings ratio of 234. When the bubble burst, smaller, unprofitable companies vanished entirely. Cisco's stock plummeted by 88% and never recovered its peak price. Key takeaway: the destruction here was due to pure speculative valuation on companies with zero financial fundamentals. The AI boom, where it differs. Now, let's look at AI. The key difference is that the giants driving this boom, Microsoft, Google, and Nvidia, are extremely profitable. They have massive, established businesses and mountains of cash. Unlike the dot-com era, the AI infrastructure is being funded primarily by these giants using internal cash flow, not reckless external debt. This provides a crucial cushion. However, the concentration is unprecedented. The danger: extreme concentration. Here's the most alarming statistic. The market weight of the top 5 S&P 500 companies is currently higher than it was at the 2000 dot-com peak. The entire market's fortunes are tied to the continued exponential success of a few AI-centric stocks. This concentration is a massive systemic risk. If any one of these titans stumbles, the impact on your 401k will be instantaneous and severe across the board. So, where does this leave us? We have dot-com valuation issues in small AI startups, but Japan-level financial strength in the mega-cap core. This suggests a middle ground outcome. The fundamentals are too strong for a complete 80% collapse, but the valuations are too stretched for a minor dip. Our prediction is for a valuation-driven correction of around 30% from the peak. This would be a painful but healthy derating, bringing the multiples back to reality without crippling the underlying, profitable technology leaders. This correction won't just happen randomly. It will be triggered by specific events. In our next video, we break down the exact timeline and triggers, including the hidden financial vulnerability of the $455 billion counterparty risk that could break the chain. If you find the video useful, do like and subscribe so more people get to watch and share. Disclaimer: information in this video is provided for educational purpose only and should not be considered as financial advice. Always do your due diligence or so speak to licensed financial advisor before making investment decisions. Thanks for watching, and see you in the next one.